In the last chapter, we learned support and resistance. Now we add the next layer, supply and demand. Support and resistance tell us where price has reacted before. Supply and demand asks why the reaction may have happened. Was there buying pressure strong enough to push price higher? Was there selling pressure strong enough to push price lower? This chapter is still not about predicting the future. It is about reading where pressure appeared and how price behaves when it returns. Supply and demand should start with a simple definition. A demand area is a place where buying pressure previously became strong enough to move price up. A supply area is a place where selling pressure previously became strong enough to move price down. The important word is pressure. We are not looking for a secret signal. We are looking for evidence that one side became stronger than the other side. When price returns to that evidence, the area deserves attention. The beginner mistake is treating supply and demand like magic. Seeing demand does not mean price must rise. Seeing supply does not mean price must fall. The area only tells you where useful information may appear. Price still has to react, reject, hold, or break. That response matters more than the label. If the market ignores the area is not doing its job anymore. So the goal is observation first, decision later. Supply and demand areas should be drawn as zones, not perfect thin lines. Real movement is messy. Price may test the top, test the bottom, or wick through and return. A thin line can make normal movement look like failure. A zone marks where pressure showed itself before. A demand area forms when buyers are strong enough to stop lower prices and push price higher. On the chart, demand often appears before a sharp move up. The move away is the clue. It shows that buyers became aggressive, or that sellers were no longer strong enough to continue. When price later comes back to that area, traders watch the response. Does buying appear again? Does price hold? Or does the area fail? A supply area forms when sellers are strong enough to stop higher prices and push price lower. On the chart, supply often appears before a sharp move down. Again, the move away is the clue. It shows that sellers became aggressive or that buyers were no longer strong enough to continue. When price comes back to that area, the question is simple. Do sellers defend it again, or does price trade through it without respect? Many supply and demand areas have two parts. First, there's a base. The base is where price pauses, compresses, or rotates for a short period. Second, there's a departure. The departure is the move away from that base. A clean departure tells you the market made a decision there. The stronger and cleaner the departure, the easier the area is to see. That does not make it guaranteed, but it makes the read clearer. Not every area has the same quality. A clean departure is sharp, direct, and easy to recognize. A weak departure is slow, overlapping, and uncertain. Beginners often mark weak areas because they want more signals. That usually creates confusion. If the move away is not obvious, the area may not be worth emphasizing clear. Areas are easier to learn from than crowded charts. The return is where the lesson becomes practical. Price leaves an area, moves away, and then comes back. That return is not an automatic trade. It is a test. At demand, you watch whether buyers show up again. At supply, you watch whether sellers show up again. Price may reject, pause, or break through. The response gives you new evidence. You will often hear traders talk about fresh areas and used areas. A fresh area has not been retested since price moved away from it. A used area has already been tested one or more times. This does not mean fresh is always better. It means the chart has less information about how price will respond there. Each test can absorb some of the remaining pressure, so when an area has been touched many times, ask whether it is still being defended. Supply and demand should not be read by itself. Structure gives the area meaning. In an uptrend, demand near a higher low may matter because it connects to the structure holding the trend together. In a downtrend, supply near a lower high may matter for the same reason. If the area has no relationship to structure, it may still be visible, but it is harder to interpret. The strongest reads usually connect pressure with structure. In an uptrend, demand areas can help explain pullbacks. Price moves up, pauses, pulls back, and then buyers may defend a higher low. That does not mean every pullback is a buying opportunity. It means demand can help you judge whether the uptrend is still healthy. If buyers continue defending higher lows, the structure remains intact. If demand fails and price breaks the structure, the story has changed. The area is useful because it gives the trend a place to prove itself. In a downtrend, supply areas can help explain rallies. Price moves down, pauses, pulls back, and then sellers may defend a lower high. Again, this is not an automatic trade signal. It is a way to read whether the downtrend is still being respected. If sellers continue defending lower highs, the structure remains intact. If supply fails and price breaks above structure, the story has changed. The area becomes part of the evidence. In a range, supply and demand often show up near the edges. The upper area may act like supply because sellers have responded there before. The lower area may act like demand because buyers have responded there before. The middle of the range is usually less useful for beginners. It gives less room and less clarity. When price is ranging, the question is not just where the area is. The question is whether price is near an edge or stuck in the middle. The safest habit is to wait for the reaction. Marking a demand area is only step 1. Watching how price behaves there is step 2. Does price reject quickly? Does it hold and build structure? Does it fail without any meaningful response? The same idea applies to supply. The reaction tells you whether the area is still active. Without the reaction, the area is only a note on the chart. Areas fail all the time. That is normal. If demand breaks cleanly, it tells you buyers did not defend that area. If supply breaks cleanly, it tells you sellers did not defend that area. The failure is not something to argue with. It is new information. Sometimes a broken demand area later acts like supply. Sometimes broken supply later acts like demand. The important part is that the chart has changed. A common beginner problem is marking every small pause as supply or demand. That makes the chart crowded very quickly. When every area matters, no area matters. Start with the most obvious zones. Look for clean movement away. Look for connection to structure. Look for room for price to move before the next major area. You do not need 20 zones on one chart. You need the few zones that explain the current story. Lower timeframes can make supply and demand harder for beginners. When you zoom in too far, every tiny pause starts to look important. That can lead to overmarking and overthinking. A cleaner approach is to begin with the larger, more obvious areas. Then use the lower time frame only to study the response. The higher time frame shows the map. The lower time frame can show the details. Do not let the details erase the map. Here's a simple beginner workflow. First, identify the market condition. Is it trending, ranging, or unclear? Second, mark the major structure. Where are the important highs and lows? Third, mark only the clean supply and demand areas that connect to that structure. Fourth, wait for price to respond. Condition, structure, area, reaction. That order keeps the read organized. The common mistakes are simple. The first mistake is drawing too many zones. The second is treating every zone as an entry. The third is ignoring the market condition. The fourth is forgetting structure. The fifth is arguing with a zone after price has clearly broken it. Supply and demand should make the chart easier to read. If the chart becomes more confusing, simplify it. Use fewer areas and demand clearer evidence. Let us recap. Demand is where buying pressure previously moved price higher. Supply is where selling pressure previously moved price lower. These areas are zones, not perfect lines. The move away from the area helps show quality. Structure gives the area meaning. The return to the area creates a test. The reaction tells you whether the area still matters. Supply and demand are not predictions. They are a way to organize evidence. In this chapter, we connected price areas to buying and selling pressure. That prepares us for the next question. When price reaches an important area, what do the candles actually show? A zone can tell you where to pay attention. Candlestick behavior can help you read the response inside that area. In the next chapter, we will slow down and study candles as evidence, not as magic patterns, but as clues about pressure, rejection, continuation, and failure.